we rewind a little bit and give a little historical context, right? The Bitcoin white paper was written in 2009, in the wake of the financial crisis. There was sort of this deep mistrust in banking. And you could extend that to, the whole fractional reserve system itself, right? And so a lot of the early people trading into crypto, they needed, something to trade out of, hence the name stable coin. They wanted it to be one-to-one, because like you said, these are not banks, these are businesses that you need to trust. But then also they didn't want to sort of feed into this fractional reserve system either. And so that's sort of why stablecoins are the way that they are. It's not to say that they're necessarily optimal that way, but as a result, they aren't capital efficient. And do you want to talk a little bit as to why that could be good or bad?
Sure. Well, in the old days, we used to have the gold standard, which meant every dollar that was out there was supposedly backed by a certain amount of gold, and you couldn't have more dollars than you had gold. And that made it really hard to expand the money supply. You had to wait until we actually dug up or got more gold. And so we moved away from that to having a flexible money supply where we could basically print more dollars than there was gold. And it meant that the US dollar was no longer backed one-to-one with gold. Well, today we have a system called banking where when you make a deposit, the bank doesn't have to keep the money there, just like they don't have to keep the gold there anymore. They can put it to work. There's a capital ratio, but basically for every $10 they take in, 9 of those can be put to work, and they keep 1 on hand in case somebody comes in and needs to take the money out. Those other $9 are used for credit, and credit is what we use to expand the economy. And that's what the private banking system does. It takes dollars, holds 1 on reserve, usually with the Federal Reserve, and lends the other 9 out. With stablecoins, you don't do that. If stablecoin money comes in, those dollars are supposed to be there. They're by law very restricted, and they can't be sent out and basically lent out the way the banking system works. And while that might be very safe, having a system that's based on one-to-one reserves collapses the credit function of the banking industry. And it's like going back to kind of like the gold age, which some people want to do, but they have to remember that was extremely restrictive, and it really collapsed the ability of the country to grow.